So, how on earth do you reduce UK inheritance tax by investing in pensions? Great question. Let's check out these details. Hi everyone, my name is Simon Mishevich from Optimize Accountants, and in this video we're going to be talking about inheritance tax mainly and pensions and investments. Now, before I get started, I am not an independent financial advisor. I am not a tied financial investment manager or anything like that. So if you're thinking about taking this advice, guidance from a tax perspective and want to invest in pensions, then please make sure you reach out to the appropriate people to talk about your pension investments. And I've got interviews lined up talking about pensions, so we'll come back to that another time. Okay, so with that said, let's talk about inheritance tax. And if you've got broader tax consequences for your investments, you might want to book a 30-minute or a 60-minute tax consultation with us. Feel free to use that QR code and book some time with us. Oh, feel free to use the code YouTube25 to get your 25% discount as well. Okay, so let's think about now then inheritance tax and how much you might have to pay. So let's imagine that you've got £400,000 worth of assets. We're going to ignore things like nil rate bands for homes. So we're just going to take the standard UK inheritance tax lifetime allowance for an individual, which is £325,000. In this case, we've got assets of 400,000, which is reduced by the inheritance tax allowance of 325,000, which brings the taxable amount down to 75,000. But the taxable amount is 40%, which in this case is going to be a whopping £30,000, which is substantial no matter which way you put it. People build up their wealth and they think about, well, how much money am I going to be left over for my kids? Your children will, or your estate will have to pay this £30,000 worth of tax. And it may not be that easy to pay for it if the money is tied up. Okay, so let's think about what people are trying to do. The people are trying to build wealth for their children, which is assets based. Want to give a legacy for their children. And if it's in the form of buy-to-let property investments or it's in cash, then it's going to be subject to this taxable amount, which can cause problems. So the couple of things I want to bear in mind is that you can invest into a pension. Now, some rules or regulations around this. Again, speak to your financial advisor about this, not me. Okay, but I'm talking from a personal perspective as much as anything else. So you can invest into a pension, and you're allowed up to £40,000 per year contribution, and it is NRE, which is net relevant earnings. So for most property investors, that gets real estate property income. That won't count towards your amount to contribute towards pension. Only things like salaries and wage self-employment income will be taken into account for NRE purposes. Now, if you are in a fortunate position to be able to do £40,000 per year and you're employed, for instance, then you could get an £8,000 tax refund. And you think, well, actually, that's only 20% tax. I know it's 40%. Well, you're absolutely right. What happens is that you could do a salary sacrifice, but if you're doing a post-salary contribution towards a pension, then you'll be given 20% back on your tax return rather than a 40% on a salary sacrifice. So there's where straight away you want to think about how you invest in pensions. Should you use your employer to make the pension contribution, or should you do it after you get your paycheck? Personally, I think a salary sacrifice is a good way of doing it to reduce your income tax liability. You do have to bear in mind that you're allowed a maximum now of £1 million or just over £1 million for lifetime allowance of 1,073,100 for pensions. Once it gets above that, there are some tax consequences which you need to consider. But if you're getting started out in pension, you're not going to reach that straight away, so that's not a problem. One thing about pensions, and I like this about pensions, is there are no income tax at all on any earnings it has. So if your pension is investing and it's receiving dividends or interest or rental income from commercial properties, that is, then there will be no tax on those earnings inside the pension, which is amazing. There's no capital gains tax. So if you do happen to sell assets in that pension pot, then again, there's no CGT. And there's no inheritance tax on death whatsoever. So if you're passing your pension pot to your children, which is the legacy that you want to be providing, well, what a great way of doing it. You're passing over your pension over to your heirs and they can make best use of it. Okay. Now, again, I need to stress, I'm not a financial advisor, but people think, well, what can you invest it into? So this is just you can get this from anywhere, okay? But your pensions can invest in stocks and shares, bonds and gilts, cash products, as well as commercial property. You'll notice I've put commercial property because it cannot invest in residential properties. It cannot invest in holiday lets, furnished holiday lets, service accommodation. No matter what you hear, a furnished holiday let is not a commercial property. So it's a residential because you sleep in it. Okay, that's what defines a dwelling. A dwelling is residential property. If you can sleep in it, it's a dwelling and therefore residential. So furnished holiday let, service accommodation will not cover this. Commercial properties, we are talking about office blocks. We are talking about restaurants or shops or warehouses, that kind of thing. All right, so do speak to a financial advisor to understand what's right for you. And I think that's probably the best thing. All right, so let's think about this. If we were thinking about, well, hold on a minute, we're going to get, if we put money into a pension, we're going to get some nice income tax savings, but that's not the only tax saving we need to think about. We've obviously talked about the growth of that pension fund is not going to be subject to tax, which it would be in your own name, but we're also saving on inheritance tax. So if you invested that 75,000, which is going to be in excess of 325,000, and you had that in cash or you converted it from assets into a pension. Commercial property can be moved into a pension. Don't know if you know that. So if you've got commercial property in your own name, move it to a pension, and all of a sudden you might get away from paying inheritance tax on that property. So here we talked about £75,000 would have been taxable, subject to £30,000 IHT, which would be now zero. That £75,000 would be growing, of course, because you'd be making good financial decisions, wouldn't you? And then that growth would be then passed on to your heirs, free from inheritance tax. And again, you've got that nice tax relief from the moment that you make contributions towards your pensions. And again, if you are investing commercial property into your pensions, that too will be deemed to be a contribution which benefits from that nice income tax relief on your self-assessment tax return. So there are many good reasons to invest in pensions to minimize inheritance tax, income tax, and capital gains tax.